stock at the right time.
10 years ago this Saturday, Lehman Brothers fell, marking for many the official beginning of the great financial crisis. All week, we're taking a look at some of the key players who really helped recover from that crisis. Today, we welcome from Newton, Massachusetts, Larry Summers, former U.S. Treasury Secretary, and now he's the Charles E. Eliot University Professor at Harvard. Larry, welcome. Good to have you here.
Good to be with you, David.
So let's start with what's different from 10 years ago. One of the things that's different is the dramatic increase in a lot of asset management, a lot of things that are not banks. We've retrenched some on banks. Things like Blackwater, like KKR, like Blackstone have really ramped up. I talked to Warren Buffett recently about whether things like Berkshire, by the way, need more regulation. This is what he said briefly.
We need some kind of regulation. If people are in massive lending activities, that we need, whatever their names, we need some kind of regulation. No, there's no question about that.
So, Larry, if the banks, the traditional banks, were a good part of the last crisis, are the non-banks likely to be a good part of the next crisis?
I think there's a real risk of that. The so-called shadow banking system, where lending takes place not through banks, carries with it, I think, very real risks. And I'm not sure we fully have our hands around those risks. So I think we've got a system that has continuing vulnerabilities.
So there's a non-bank risk. How much risk is left with the traditional banks? Because recently you were talking about the Boston Fed, and you said actually that that the stress tests were comically absurd. This is what you said. That, I would suggest, is a comically absurd conclusion that is belied by the most elementary analysis of the beta of those major institutions. What is comically absurd about the stress tests as they're being applied today?
The Fed concludes each year that, this year being typical, that they take some scenario where, for example, the stock market falls by 60%, the house prices fall by substantially more than they fell in 2008, the unemployment rate gets up near 10%, and then they run them through some model, and they say that all the banks, even if they continue to pay their dividends, won't need any new capital and will fully meet their capital standard. And I just think that's very unlikely to be true. You can do a simple calculation, which is to look at the relationship between the banks and the aggregate stock market, the so-called beta. And you know what that tells you is that if the stock market goes down by 60%, bank stocks will probably be down 80 or 90%. And maybe if bank stocks are down 80 or 90%, everybody will have confidence in all the banks. But that would not be my reading of the historical experience. So I'm not sure we need to have a financial system that can easily withstand, without raising new capital, a decline of that magnitude. But it seems to me that for the central bank to assert confidently, as it does each year, that we have such a system doesn't do a great deal for anybody's credibility. I think the issues go crucially to and this gets pretty technical pretty fast, the distinctions between regulatory capital and economic capital. You know, by the official regulatory standard, Bear Stearns was overcapitalized the day it failed. WAMU was overcapitalized the day it failed. And there are more examples of that kind. So I think we have a system that's rooted in a particular paradigm around a particular definition of regulatory capital. And it's a mistake to take that overly seriously for what we really care about, which is the underlying soundness of institutions. I think one of the lessons of 2008 is that markets were telling us that financial institutions were in growing difficulty,
right,
and that their situation was increasingly problematic through the early and middle part of the year, and the regulatory authorities really didn't do much. And that was one of the things that, if they had been able to do things, we might not have seen such Armageddon in the fall.
So, Larry, if we still have risks that we should be addressing and are not, let me understand correctly. Do you think the stress test is a good way to get at it? It's just being misapplied? And similarly, with respect to capital requirements, the capital is greater than it was. Are we misdefining it, or we just have not taken the numbers up high enough?
I think the stress tests and the increased capital regulation are steps in the right direction. I think there's no question that we've done constructive things since 2008. I think the dangers are that we are too complacent about their full sufficiency, and that we are starting to chip away at that regulation. We're declaring institutions that used to be systemic now not to be systemic. We're reducing the regulation on large but not immense institutions with capital in the $250 billion range. We're redefining aspects of the measurement of capital to make the standards less onerous. So I think it's fine to have a paradigm based on capital. I think having stress tests are a good thing. I just think we need to bring more market reality into that system if we want to be confident. I also think that we're ahead in the United States,
well,
and
Larry,
matters lag badly in the rest of the world.
Larry, that goes to my next question, because if you're more conservative on the health of U.S. banks, like, what must you think of European banks, and what kind of risk was that pose to the global financial world?
Oh, look, I think you have some potentially very serious issues in Europe when banks are selling at half of their book value or less. That is telling you something about the underlying health of those institutions. And when we don't recognize that in assessing their soundness, I think we make a serious mistake. So I think there continues to be risk of what years ago was called a doom loop in Europe, where banks are holders of government debt, and if the banks get called into question, that reduces the demand for the government debt, which raises its yield, which makes the bank situation less healthy, which in turn makes the government debt harder to roll over. And I don't think we've taken those risks completely off the table.
Well, then how do you see the financial system there evolving? Because it's primarily based on bank loans, but the debt market is now beginning to take more shape. We're seeing a lot more issuance come into the bond market. Is that kind of risk a systemic one like we saw in the U.S., or contained?
I think you still have European banks that are substantially larger relative to the underlying economies than we do in the United States. And so I think there does continue to be real risk in Europe. Now, I'm not predicting some kind of crash this year or next year, but I think there are real risks in the system. I think there are risks in emerging markets. We don't really know yet whether Argentina and Turkey, and to a lesser extent South Africa and India and Pakistan, are isolated instances, each to be thought about in terms of their own fundamentals, or are the tip of an iceberg of emerging market problem as as dollar interest rates rise and possibly the dollar appreciates. We don't really know what those risks are, but I think one does have to recognize that there are real risks. One also has to recognize that there's a lot that we don't understand in China. On the one hand, the Chinese authorities have shown themselves to have a lot of competence. The Chinese authorities have many more levers for supporting the financial system than would be common in Western countries. On the other hand, the one fact that's pretty clear is that if you look at aggregate debt ratios in China, even with China's rapid GDP growth, debt has grown substantially more rapidly.
Right. Larry, let me bring back to the United States for a moment. There's one way,
Sure.
at least, in which President Trump is demonstrably unique, at least in modern history. If you go back all the way to President Reagan, every single president's presidential approval ratings have been higher than the overall approval rating for the economy. President Trump, it's the reverse. His presidential approval ratings are actually less than the favorable view of the economy overall. Is that fair? Does he deserve more credit for the strength of the economy than he is getting?
No. First, David, I think some of the reason why what you describe is happening is not because of judgments people are making about the economy. It's because of characterological judgments, if I can call it that people are making about President Trump that are uniquely negative. And so, given whatever they think about the economy, they see a lot of other separate issues with respect to the president. Look, if you want to make the case that the president, I'm not saying that the president hasn't done nothing that has spurred economic growth in this short run. But I think an honest assessment needs to recognize 3 points. One, growth was significant and expanding during the Obama years. In fact, in the last year and a half of the Obama administration, job creation was faster than it's been in the United States since President Trump took office. Second, there has been a worldwide acceleration in economic growth. In fact, over the 2017 and 2018 periods, the upwards revision for the United States has been smaller than the upward revision for the rest of the world economy. So it's hard to say that President Trump deserves more credit for what's happened abroad than what's happened in the United States. And yes, the U.S. stock market has been strong, but it's been driven by foreign profits. I think the third thing is that some of this prosperity is being borrowed from the future as we run up federal deficits and do other things that are probably unsustainable.
So it's fair to say that people are probably right this time, at least from your point of view. Larry, it's always a real treat to have you on. Thank you so much. That's Larry Summers, former U.S. Treasury Secretary.